opportunity to welcome all of you to this webinar on digitalization strategy. We are very fortunate this afternoon to be joined by Mr. Andrew Lake. This program is in conjunction with Capital Plus Exchange, CAPLUS for short. And we are fortunate this afternoon to have a digital expert, Mr. Andrew Lake, who will take us through the 4 basic digital strategies for financial institutions, and to also share his strategy and questions as sorry, there was a technical hitch there when I was introducing the speaker for the program. So like I was saying, we have Mr. Andrew Lake, who has worked with the World Bank, IFC on digital financial services. He was a chief mobile officer for MTN in South Africa and CEO for Mode Holdings, where he implemented a full mobile banking operation. We will appreciate if you submit whatever we are doing will be recorded. We will send you other materials that he will use program. So please kindly send in your name and then your institution and then your email address into the chat box as he starts. And then if you have any question, you can type it into the chat box as well. I will signal him and let him have it so that he can address it. Either way, you can also signal us by raising up your hand so that we give you the permission to come up with your question. Mr. Andrew Lake, over to you. The participants are ready for the session. Thank you so much.
Thank you very much. Thank you very much, Alex. And yes, welcome to the session on digital. It is the second strategic workshop that we're doing on digital in this program. And yes, I welcome you all to it. Technical glitch. Why is this not paging? Okay, what we'll be covering today is a market contextualization of why we're looking at digital and SMEs specifically. We'll look at the strategic benefits of digital in the SME finance, what a typical journey would look like for an institution, and then we'll have a look at each of us will have a look at our own digital journeys as we progress. So just briefly, the main focus of the MasterCard intervention is on SMEs and MSMEs, and that is simply because 92% of all Ghanaian businesses are MSMEs, and they generate 82% of the employment in the country. They are being held back by a shortage of funding. There's said to be a shortage of $5 billion worth of funding for SMEs generally, and 242 million specifically for women SMEs. So the intention of this program is to strengthen the financial institutions to deliver financial services to the SMEs and thereby strengthen the SMEs with the overall intention of increasing employment. So what does this word digital actually mean when we speak about it? Well, I'll start by being negative, and it's not about IT. It is facilitated by IT, but it is a fundamental shift in business which we run on top of IT solutions. So it is more about business than it is about technology. So how can it help me? Digital banking and the agency banking that it supports allow banks or other parties to use technology to open up existing infrastructure to deliver superior banking services to customers off a lower base. It's quite interesting to look back at these claims. First of all, the banks and other parties. In Ghana specifically, you've seen a massive entry of the telcos into the banking sector, facilitated off technology, very much so. Mobile money is technology centric, and very importantly, they have 440,000 odd agents who are existing shops who are enabled by the technology deployed and as part of mobile money. This enables them to deliver services directly to the population wherever they are, and it costs a lot less than to run a branch infrastructure. So that, in essence, is how it works. This digital, of course, can be made to work similarly for any other entity too, and it's about embracing or not these techniques to grow our businesses. Of course, our recommendation is and remains that we do embrace it. Why is it important? There are new entrants, as I've mentioned, into the sector, mostly technologically enabled. The little pink cake, which I'm pointing to with my mouse, is the current businesses of the bank, and they are under threat from new entrants. First of all, the telcos, as I've mentioned, and then behind them is a whole raft of fintechs who are already active in the market. Some of them are visible directly in the Ghanaian market. Some of them are operating in the Ghanaian market, but not necessarily directly visible. And directly behind them come the behemoths, the likes of Google and Amazon, etc., who are going to ride on top of the rails that we have built as financial institutions and service the market. So the bottom line is that as FIs, we need to adapt and adapt our business models and say to ourselves, how do we respond to this, and how do we ensure that we have adequate responses in the market? We also have advances in digital services which are already changing the way we do business. Credit decisions are now facilitated very quickly by things like artificial intelligence. Innovative financial products have come to the market, and very importantly, and I'll go into this in more detail later, the Ghanaian market is very young, and the youth market is very much technology driven. For the most part, if you're not on a young person's phone, you might as well not exist. So it's about making sure that we are ready for the new market. So is there a need for digital, and is it real? This is a piece of research conducted in 2018 by the Boston Consulting Group, and it's an interesting view into the perceptions of CEOs of digital. On these horizontal bars that you see here, where I'm pointing with my mouse, the red refers to strongly agreed to by bank CEOs. The gray in the center is not sure, and the dark bit on the right is the answer is no. And so the research took the form of, do you believe this following statement? And so if we go down the statements and have a look, statement one is digital will fundamentally change the economics and competitive banking landscape of banking. 86% say yes. In the battle for market share, fintechs, big tech, and outside players will become serious competitors of ours. 52% are yes. My organization has a clear digital strategy and a vision for the corporate bank and a well-defined roadmap for digitization. 19% agree with that. I consider my organization to be market leading with regard to digital capabilities. 43% say yes, and it's interesting to juxtapose the 19 versus the 43. It's very difficult to understand how one can be market leading without having a plan. To move fast on digital, my bank has already embarked upon a cooperation model with fintechs. 57% say yes. In the large corporate banks, this has largely taken the form of buying and or otherwise subsuming the fintechs. Of course, for smaller entities, it's going to be more about partnership than acquisition. My banking technology infrastructure is complicated and a hindrance to my completely enabling digital. And this is where the smaller banks, I believe, have a significant advantage, simply because they do not have legacy systems. This means that they are in a position to go straight to the more digital or the more customer-focused digital platforms without having to extract their legacy platforms. So what is the strategic benefit of digital to SME finance? In adopting digital for my institution, how does it help me? The most important question we need to ask is, what do we want out of digital? This may sound trite, but if we have, as institutions, have clarity on where we want to go, we know where to put our resources. So organizations that have a clear focus tend to use that focus to define their ambition in terms of digital and where they invest their money and their energy. It's also very important the projects to implement digital tend to be relatively large and relatively large budget. And when one is committing that kind of resource, it is very clear, very important to have clarity about why you're doing it and to retain that clarity through the long decisions and long lines of decisions and nights of hard work that will come. And last but not least, it reduces tinkering. Technology is fun stuff. There's a lot that can be done, and there's a lot of people spend time toying with technology and to see what it can do. The advantage of that is that you gain experience of what is technically feasible. The disadvantage is that if you are not guided by an overall strategy, you tend to become a tinkerer. The risk is that we become tinkerers, and this is both expensive and time consuming, whereas following a strategy, a business strategy, tends to lead us directly in the right direction. So what strategies can we serve? If you look at this grid, the top right green bit here where my mouse is, we talk about expansion, and this, by expansion I mean more market share, perhaps in existing markets, perhaps the ability to target new markets which were hitherto unreachable. Digital opens the opportunity to expand into places where you do not have any footprint whatsoever via agency, and the ability to market under secondary brands, where some banks have taken the position of standing behind the fintech and presenting their product to the market as being from the fintech, where in actual fact allows them to run in the market under two brands, their own and that of the fintech. Cost containment is also very important, and it's something that many institutions follow, and that is, with digitization and process automation, we are able to reduce the reliance on manpower to do a lot of things. We're able to automate and deliver products more quickly to market, and therefore change the cost structure of our organizations. Customer service, being right here, right now in the customer's life, changes the dynamic of your customer relationships completely, and digital is definitely a way to do that. Defensive, many institutions, or some institutions, have taken a view that says we are digitized enough, and they limit their future expansion and expense to having sufficient services so that they can retain their bases. In other words, if a client came to them and said, listen, I'm going to leave because I prefer the service from Bank B, they simply say, we have one too. It's a defensive strategy, it's minimal investment, but it's about protecting the base. So what does expansion look like? And I'm going to, for the most part in this presentation, speak in terms of examples because it's easier than going to theory. If we look at mobile money in Ghana, mobile money started in Ghana in 2009, which makes it about 12 years old. Standard Chartered Bank started in Ghana and claims to be the oldest bank in 1896, making it 125 years old, about 10 times the age of mobile money. Mobile money customer base, as at December last year, was 17.5 million people. The Ghanaian population in total is about 32 million people. Very important, and it refers back to my previous comment. The youth, the Ghanaian market on average is young. 56% of the population is below 25 years old. And the population penetration of Momo is about 54% of the total population. So certainly all of the adults, and also starting to move down below that as well. At the same time, the total banking sector has delivered banking services to about 57.5% or 57% of the Ghanaian market, which means that it's likely that 94 or more % of all account holders are working with mobile money too. So what this effectively means is that all of our clients have both a relationship with our entity as well as with mobile money. And how does this look from a transactional and a usage point of view? All of the figures that you see in front of you come from the Bank of Ghana's annual report of 2020. If you have a look at the mobile money volume of transactions, where my mouse is, you'll see that they did about 2.8 billion transactions in the year of 2020, which is roughly 35 times all of the transactions effected by the sum of all other not on us electronic transactions in the market. And the value that they switched at the same time at 564 million was is about 2.5 times the total value switched by all of the other channels of the not on us transactions in the market. In that same year, the balances in the mobile money accounts rose by 92% to reach 6.98 billion. A new chapter in this expansion game has recently opened, with MTN fielding their quick loan product, which effectively means they've now entered unsecured lending. They're doing it with lending businesses such as AFB and Letshego, and the sales volumes are not widely reported, although in a slide later I'll take you through some information from Letshego, which I think points to the success of the strategy for them. So that shows you the kind of expansion that is technically feasible when you deploy a digital bank. On the cost containment front, if we have a look at Letshego, speaking of which, you will see that the figures that I'm showing you here come from their annual interim report from 2021. You will see that they currently have 4.2 million clients. As a result of their digital strategy, their cost to income ratio has dropped from 49% to 47%, so a 2% improvement in cost to income ratio. While at the bottom there, where my arrow is going to go, is now the loss ratio has remained constant at 1.4%. So what this effectively means is that they are achieving phenomenal growth while at the same time driving cost out of their business by going digital. In these graphs on the right-hand side, you will see that their digital adoption rate has risen dramatically since January 2020. And as it has done so, if you look at the lower graph, you'll see that it has reduced dependency on the other channels of Letshego, which has been very important, and I would say contributed significantly to those reductions in cost to income ratio. Customer service. There are two ways you can go. You can view customer service, of course, in many ways, but just by way of example, let's walk through loan acquisition. And there are two ways that you could look at doing it digitally. One is a facilitated approach, which is effectively to automate or support your loan officers more effectively using digital products. And the other way would be to go to a customer self-service type structure. Facilitation is an automation, if you like, of business as usual for your business, whereas a customer self-service is closer to the product, to the mechanisms deployed by mobile money. Both of them involve touching the customer as few times as possible to open an account. So instead of having them come to the branch to fill out a form and then sending the appraisal officer out to go and visit, in one move, we can send the loan officer in the facilitated approach we can send the loan officer out to the client. They can gather everything they need, including photographs of the MSME, the nature of the shop, the state of the current business, all financials photographed and captured, an application form completed, all of this done in real time, standing in the client's offices, and the loan application transferred straight to head office or to the branch, depending on commercial decisions taken by your organization for appraisal. Loan disbursement could then take place via mobile money, and collection similarly can take place via mobile money. What this does is it enables you to deliver really quick loan decisions. You can relatively simply reduce loan processing times from current around two weeks to possibly 24 to 48 hours is feasible by doing this type of thing. Having the customer self-service is fairly similar, except that you ask the customer to just send you the information and of course conduct spot checks on what is sent to you. But from the green block, from loan approval onwards, there is little difference between loans which are originated through your staff on client premises and those that are originated by client direct approach. I guess what we're trying to put across is that you are limited really only by your imagination, your risk appetite, and any capital constraints you may have. Defensive. The best way to look at, best analogy to look at defensive is to look at farming. In many years ago, and still currently, some farms were harvested entirely manually, and we had teams of people in the fields cutting, in this example, wheat. In the 80s, 90s, levels of mechanization rose, and we were able to reduce the staff count by a small amount by fielding tractors which thresh the wheat ourselves. We've now reached the point up at the top here where we have fully automated machines that drive themselves, work 24 hours a day and harvest on behalf of farmers. So too, the banking sector has gone through similar changes. We've had places, we started out with highly manually driven processes, which were then automated to some extent by the implementation of core banking systems, which mostly affected the back office. And then now we've reached the point where digital is being delivered through the front end, completely automated. There is a big difference in terms of service levels provided. The automated mechanisms at the top are quick, but they're completely impersonal, whereas the ones down at the bottom tend to be much slower, but they are much more personal. So there is a possibility here to differentiate. If one understands this entire structure and all of these banking sector participants that correspond to each of these are active in the Ghanaian market. People at any point on this hierarchy can take a view that says we can provide enough to tell our clients that we have one too. So if you are sitting, for instance, over here with a core banking system and a GIPS card in the market, you could tell your clients that they can draw cash anywhere they like as long as it's banking infrastructure, which goes to some extent to ameliorate the difference between that and mobile money, where the agents are fairly broadly spread. So if one chose a defensive strategy, it would be to put yourself in a position to say, yes, but we have something similar, so please don't leave. So what does a journey look like? We start by looking at what a typical journey looks like so I've got pictures over my slide here. We'll start by looking at what the four pillars of the journey look like. And if we go from left to right across the screen, we're talking about reinventing our customer journey, leveraging the power of data, redefining the operating model, and building a digital organization. Reinventing a customer journey is about picking the customer up and making them the center point of our businesses, and defining everything, shifting the focus from what we provide to the market to what the market wants from us, which sounds like a small change, but it isn't. It changes entirely the way you look at your customers, and if that becomes pervasive in our organizations, it changes how we service our customers, and therefore we are able to produce frictionless interaction. Hiding complexity is very important because clients don't want loans, they want to buy stuff, and all of the paperwork and all of the work that we subject our clients to is, while very important from a risk management point of view, it does impede the relationship we establish with the client. So we need to not remove the complexity, but hide it, which is possible with technology. Be at our customers' fingertips again, which is back to the point of being within reach, digital reach all the time. And we must provide easy and instinctual use. It must be easy for our clients to work with us. Data is key to growing our businesses. All of us have data inside of our businesses, but not all of us use it completely all of the time to enrich our customers' lives. So for instance, when a client loan is up for renewal, we may want to dip into previous history we have with that client and adjust loan structure and loan terms based on past performance of the client. So a client who has come on board and has serviced their loan well and has completed payment all on time and on schedule, we should reward them to maintain a longer term, to retain their loyalty as we go forward. Be that by some way of gifting or alternatively reflecting it in the rate that we charge, because we now have a better view of what the client's risk to our business really is. That, of course, requires that we have the ability to process the data of their previous performance at the time of reissuing the loan. Redefining the business operating model, most businesses start with what is called business as usual plus. And what this effectively comes down to is your existing business structure with some digital channels. So we add, for instance, a mobile menu to the client's phone, but the core relationship remains with the branch, and the branch remains the face of the business. This is often, as I said before, the first step that financial institutions take into digital. The next one is a digital-driven organization, where we create a new digital business unit within our organization, which uses existing infrastructure such as HR and finance and all the rest of it, that gets involved in a form of cooperation and competition for client services with our core business. But the P&L often remains with the branch. This enables a greater focus on digital and enables us to unlock more digital mindsets, but at the same time retains our existing branch structure. What some of the very large banking groups have done is to field digital native businesses. Now, this is an entirely standalone operation, which typically trades under the license of the existing bank, but in competition with it. And that allows the banking group as a whole to have two bites at the apple. On the one hand, there is their traditional banking business. On the other hand, there's the digital business in competition with it, and the two effectively compete for business. In these businesses, the digital native business typically has its own P&L, and it competes head-on with the bank. But the group as a whole benefits because a customer of either is a customer of both, effectively. When we build a digital-driven organization, we treat digital as a priority. We create an environment in which we have a clearly articulated strategy, back to that grid that I spoke about earlier. We give it dedicated funding and dedicated talent, and we encourage it to take risk. And that doesn't mean recklessly take risk, but the risks in the digital world are very different to the risks outside, because you can become involved in real-time risk management much more effectively in the digital channels than you can without digital. And so this enables you to re-look at a lot of the risks that the business faces. And the overall objective of doing all of this, because this you will see is fairly significant change to the business, is winning customers' hearts and minds. This business, the digital business, is really about centering your bank, your customers' minds and their hearts, to attract them, to retain them, and ultimately drive your business profitability. So what would a digital journey look like for an FI? The digital journey stands on the core of your digital operation. And that core is based on customer centricity over here, your core banking system, the security, and the digital identity. Customer centricity has to be driven from the top of the organization. Having customer centricity is driven by senior management, always asking people, so this new idea of yours, how will it help our customers? What is in it for our customers? Explain to me why the customer would want it. Core banking and security are not a competitive arena at all. They are fundamental. Your business, your digital business will stand on top of your core banking system and on top of the security, but it's not competitive. So it's something we need to just get it right, and it needs to be stable. For core banking systems, we recommend the big name ones. The simple reason being that they have been implemented a million times, not a million, several times, and virtually every digital strategy under the sun has been executed on top of them, which means that you can get help to execute your digital strategy on top of it with relative ease and at much lower cost than if you end up with a small core banking system which nobody else has, because you will find yourself as in an unenviable role that we refer to as the bleeding edge, where you end up defining how moving the core banking into greater digital environments, but at great risk and cost to your own organization. Right. Once our core is stable, we can then move on to what is called access. The last part of the core, which I didn't mention on the previous slide, is your digital identity. A digital identity is fundamental to all digital, for the very simple reason that the reason you're able through digital to access existing infrastructure is that you can see your customer electronically through other people. So if a person walks into an agent and it is your agent and he swipes his card, you know that your client was present at that agent and you can authorize the cash withdrawal. Or his phone was used, or the thumbprint that you took, the thumb biometric that you took is present at the transaction. You know that your client is transacting remotely in the remote access environment. So that is why the digital ID is part of the core. Assuming your core is stable and running well, we can then move on to access to your core. And that comes in two forms: convenient cash handling and customer self-service, which we need to get a balance between these, and this balance is driven by your strategy. So what is convenient cash handling? The definition of convenient cash handling has become cash within 10 minutes walk of where I am. Now, this 10 minutes walk can be achieved in a number of ways. We can send our staff to collect and dispense cash, as is currently done in the Susu market. We can field our own agents at some cost and commercial risk. We can use Momo as a cash agent aggregator. They already have all the agents, and if you can transfer funds from the Momo account directly to your account, you effectively gain access to all of those agents. And then, of course, there is the option of ATM access across the other banks. In terms of customer self-service, this green scroll over here is the typical list of services that customers provide for themselves on digital channels. When one looks at one's customers, when one is choosing which digital channel to use for customer self-service, one must look at one's customers and say, what would fit most easily into their lives? So something that hasn't been explored sufficiently in the emergence of digital, I believe, is call center banking. This does not require literacy from your clients. So provided you are able, through your customer's digital ID, to prove that you are speaking to the right person at the call center, you could initiate a lot of these transactions on behalf of the client with a small number of staff sitting in a call center, which would, as I say, bypass all the challenges of the technology integration to the phone. It would bypass literacy issues which exist, and certainly would bypass lack of internet access and lack of smartphones, which limit the amount of phone apps we can deploy. So that's one option. Another option, of course, is the phone itself. We could put out a USSD and or smartphone app, and finally the internet, which of course is relatively nascent in Ghana. So effectively, these are all options available. You can do 1, 2, or 3 of them, and all of them would foster customer self-service and that moment of being right with your customer at any point in time. Once we have solved the core, and we've solved our customer self-service, and we've solved our cash handling, we can move on to the value-added services layer. And this is the layer where most software companies place emphasis in all of their presentations, because it's where the fun stuff happens, and it's where the real differentiation between the financial institutions happens. So bottom right corner here, within the value-added stack, is our APIs, which typically initially revolve around access to cash, access to electronic funds. So for instance, if you chose your go-to-market model to serve your farmers as to do some sort of structured arrangement with product takeoff organizations, you could enable the product takeoff organizations to pay your clients directly through your bank, the customer's bank account with your institution, by sending money through an API. This may extend ultimately to things like open banking and customer financial management tools as you progress. Customer life integration, in the case of SMEs, if we continue with the farmer MSME analogy, we could, for instance, we could integrate ourselves with, as I said before, the takeoff institutions as well as the input providers, and we could possibly aggregate our farming clients and go back to these institutions and get special deals for our clients. And suddenly our value proposition to our client is a lot better than it was when we were just financing their inputs. In addition to that, we could add to our mobile application things like weather and climate projections, as well as the current commodity prices for our farmers. So we could help our farmers not only to procure what they need, but also to farm better, because we give them the tools they need to make better decisions inside their own business. And that, of course, translates to better business for them and better loan risk to yourselves as the financial institution. Digitally immersive experiences, I think, is probably one of the last things that would be implemented in the savings and loan and MFI markets. This is typically where we set up destination branches with immersive involvement. Some banks have gone so far as to make their branches feel more like an Apple store than a branch. I would suggest that this kind of experience is probably one of the last ones that one would implement as a finance and loan and or MFI. AI and automation of tasks, on the other hand, is a very good way of managing cost. Automated credit scoring is here. It works. It drives cost out of the business, and it also makes for much more predictable decision making on loan applications. Chatbots are interesting extensions, especially if we've chosen our customer self-service to be through a call center. Chatbots are mechanisms which allow the client to speak to a computer, even though they don't know it, and the computer can answer many of the questions before we even have our staff speak to the client. Customer relationship extension would be the next thing, and that goes back to understanding, well, for instance, things like where we get involved in lending for a second time, where we start involving ourselves deeper and deeper into the client relationship with the client by offering him special rates, possibly gifting to him or her as a result of a good relationship today. So the value added section is where you definitely get to differentiate yourself, but your core and your access need to be stable to do all of it, because these things stand on top of each other, and weakness at the bottom, at the inner layers, make the outer layers weak as well. So we would obviously must make sure that our core banking and our core is strong. So if I can just pop back to the previous slide, you will appreciate that as an institution, you get to decide how you roll out. The core has to be done first. It has to be stable. But after that, the access and the value added stacks, you get to kind of choose. You could choose a line, for instance, core bank, core correct, getting the core right, getting the cash right, and going straight to APIs, if that made sense to your business or your clients. Or core and cash and then AI might be another way to look at your business from if you want to be able to, if your strategy were cost containment, you could then basically link yourself up and then very quickly move to the parts of digital that will have the largest impact on your bottom line. So I guess what I'm trying to say is that there is no single journey which suits all entities. Your journey is going to be very personal to your own organization. And after this chat, we will be circulating worksheets which enable you to look at your business, at your customer base, and make decisions off the hard facts of who you do business with, which will make the most sense and help to steer you to define your own digital path that makes the most sense to your business. Digital gives you what boils down to a box of Lego blocks. Effectively, there are many tools that you can gain access to by buying or renting or paying a service provider. But the arrangement of these blocks and how you put it all together and how you service your clients is where you create the value for your business. So what does our own digital journey look like? To choose our digital, to execute our own and define our own digital journey, we need to choose a strategy. Are we in this for expansion, customer service, cost reduction, or defensiveness? Once we've chosen that, we need to ask ourselves, to what extent are we willing to change our organization to support that strategy? Are we going for business as usual plus, or digital driven organization, or are we going to go all the way and implement a digital native business? Stabilization and strengthening of the core. Customer centricity can, as I said before, can only be achieved top down. Your core banking system has to be rock solid, because some organizations that I've spoken to are having trouble with the ability to link to cash handling, their ability to do month end. The problem is that those problems don't go away. So if you build a digital structure on top of a core banking system which has problems, those problems will simply permeate the whole thing, and will risk the one will permeate and affect your new digital solutions. And very importantly, digital solutions tend to make your business become real time in the life of your customer. And so what it comes down to is, while you are in real time, your customer will see every time something goes wrong, which is bad for business. Your security needs to be fully compliant, and your customers have to have relevant and easy use of digital identity. You need to choose the right access paths, which are relevant to your customer base, not to anybody else's. The 10-minute walk for cash transactions is key. Customer service, self-service must be accessible by all customers and must suit the needs of the majority of your customers. When you start choosing your value-added services, your customer relevance is key. We have to look at our customer base and say, of all of the options, and there are a lot of them, that could be achieved in the value-added ring around the outside, what matters the most to our customers, and what of those will also help us as a bank either expand, improve our customer care, do cost reduction, or defend ourselves. Key to all digital projects is to keep a very, very close eye on your implementation costs and your operational risk register, because these projects tend to be fairly large and managing them requires a BDI on total cost of operation and net profit that the business will generate. So we've looked at digital, we've seen its capabilities, we've explored the breadth of what is possible. Gamfin will be sending you the worksheets that I mentioned a few moments ago to help you to think through your digital strategy and make the right choices for you. So any discussion or questions? I see in the chat box I've got 8, so let me just pop that open and see what's there. Bear with. Right, from Jibril. Oh, sorry, that's not a request. Okay. Sorry, I'm just looking for any questions that may have come through. If anybody would like to just unmute and ask a question verbally, it would also be great. Any questions? Okay, I'm not hearing any questions.
Hello, Andrew.
Hi.
Sakofa.
Hi, Kofa. Yes.
Sharing the time with us. May I know how much your services cost in terms of implementation, just any aspect of the various solutions that you have? Any specific amount? I mean, can you give us an idea of possibly how much solutions are?
Okay. Obviously, as with all things, what you ask me is if I can put an analogy down is how much does a car cost? Now, obviously that depends what you choose to buy. But let's pop up this thing and have a look. Core banking systems, the good ones can cost you probably about up to about $1 million by the time they work. But there's a cheaper option, and that would be to work in the cloud, so that effectively you can access a bunch of skills on a pay-as-you-go basis rather than paying it up front. So that's the kind of money to get your core right. You're looking at probably, including your security, you're looking at easily $1 million to get your core banking and your kernel right. If you do it inside your own infrastructure, you could save some money by going outside. Convenient cash handling. If you chose to roll out your own agency network, that's very expensive because you need to manage a whole lot of external entities. You need to build infrastructure inside your organization, which enables you to manage third parties and the cash in their tills. Setting up a net. If I can maybe jump out and answer that question slightly differently, the cost to a mobile network operator of implementing mobile money, the technology that does it is the cheapest part. It's less than 20% of the total cost. About 80%, well, 70% of the remaining cost that gets sunk into it is sunk into two things. That's marketing and customer awareness and rolling out an agent network, because the agent network requires that you fund it before your customers start using it. If you feel that, just if I can express it this way, if you fielded an agent network tomorrow and your clients took a while to start using it, that agent network, if you don't give them money to just wait for your clients, will grow bored and stop selling your services. So the first client that would arrive in this scenario, at their office would be told, sorry, I don't do this. So you have to pay that agent to start off with, just to be there and to answer nicely when your clients walk in. Then over time, the usage levels rise. Okay, so that funding is going to come back against the organization, of course, and you need to roll that in. Out here, gosh, I mean, again, it very much depends what you do, but I hope that answers your question.
Okay. Thanks. At least I have some information, so I'm grateful.
Sorry, I can't hear you.
Oh, okay. So I was saying that I was expressing my gratitude for the explanations you gave. I was actually making like something like the credit scoring, automated credit scoring platform, for example. You know,
Okay.
if, I have a core banking system already, and I wanted some automated credit scoring.
Okay, when you get involved in credit, scoring, you've got two choices. Again, as always, you've got choices. But the probably depending on the size of your organization and how many clients you've got, there are two ways you can go about it, kind of two broad categories of ways you can go about it. One is to build up a set of credit scorecards for your organization. Probably you'll end up with one or with a scorecard per client or per type or per product. And also then you need the platform on which it runs, which gathers the data from your core banking system and applies it to the scorecard, as well as and also gathers, of course, the information from the loan application and applies it. That's a fairly substantial investment that's required from your organization. Another alternative would be to have a turnkey arrangement with one of the providers, somebody like Experian or Credit Inform, where they effectively run it for you as a bureau, and you just buy the credit score for each of them. That would probably be, depending on the size of your customer base again, that would probably be a good way to explore it initially, because that way you can see how well it works in your organization before you commit the fairly substantial amounts of money involved in setting up a credit scoring engine of your own. If AI and machine learning is also, well, that's, you're starting to get into very new technologies. So again, probably my recommendation would be, depending on the size of your organization, that you that you explore it rather on a bureau basis and pay per credit decision.
Okay.
Alex, I see you.
Thank you. Thank you very
Pleasure.
much.
Alex, I see your hand.
Andrew, there are two questions in the chat box. If you can take them. There are two questions in the chat box.
All right, let me just go down there. Bear with. Okay, does a Momo phone number count as a digital identity? The answer to that is yes and no. Yes, it is. It is a digital identity, absolutely is, but you have to ask yourself the questions, whose digital identity is it? So in as much as you can identify the individual through Momo, and Momo will certify to you that the client did the transaction. The point is that the digital identity is actually issued by the Momo operator, and therefore the client is actually the relationship that is being fostered is the relationship between Momo and the client. So yes, it is, but yes, it is a digital identity, but it actually belongs to somebody else and is entrenching the relationship of somebody else. I'm just scrolling through looking for the other question. Okay, I'm not finding another question in the list. Oh, down the bottom maybe. No. All right. Any other questions? Anybody want to raise their hand?
The other question was that, do you recommend that we link our organization to Momo for push and pull?
Okay. Yes, on balance, it's probably a good idea from a low cost cash collection perspective. I know that the mobile money organizations charge what look like astronomical prices to use their infrastructure. But I think what we need to bear in mind is the cost of handling cash inside our own organization. Many organizations haven't done activity-based costing to work out what it actually costs them to have a client walk into their branch and make a payment, or alternatively to have a loan disbursement. Those numbers tend to be quite big. We did some research when I was at the IFC many years ago, and it ranges between $2 and $6 to handle a cash deposit, depending on, and that was based on MFIs giving their opinion based on absorbed costing, but it wasn't based on highly scientific costing. So that is the reason to do it. The reason to do it is very quick distribution and low cost of operation, relatively speaking. The reason that we have to be a little bit cautious about it is that the Momo operators get complete view of your customers. They will, if you disperse through Momo and collect through Momo, they see the loans getting disbursed, they see the payments coming in, they are able to credit vet your clients as potential lending clients for themselves quite easily. So it's going to be a balancing decision for you as senior managers to make a call on your business as to whether or not it's worth the risk for the cost savings. Any more questions?
There's one more question in there. What workaround can we use if our digital core is not yet stable?
Sorry, it broke up. I'm looking for it. What we're going. Oh, okay. There are organizations, as I mentioned in my presentation, as I've been working with organizations in and around Ghana, I've come to some. I've met some whose cores are in need of work. There's two routes forward. First of all, it is fundamental that we get this right before we do anything else in digital. So there's no getting around doing it. What there is more a case of what are my options to fix it. Option A, of course, is just to replace it. That is a fairly big piece of surgery on a business because your operational processes are typically built around your existing system. So on the one hand, you can't carry on with a system that's just frustrating you. So one option would be to replace it and possibly go into the cloud instead of buying your own new system. The other alternative, of course, is always best to start with a really hard look at why the core is weak in and of itself. Most cores are recoverable. There's very few banking systems out there that are honestly terrible. It's generally an implementation problem, which can sometimes be fixed. So what we tend to advise clients to do is to start with a really in-depth look at why their core is unstable, what's making it unstable, and what is it worth fixing. And if the answer to that is yes, then that's generally the cheaper option. If the answer to that is no, then unfortunately it's a new system time. Do we have any more questions? Okay. Right, I suggest then that Binyam, if you would like to chat about what comes next.
This isn't Binyam, but I can I can respond. We will be sending out this presentation plus 5 handouts that if you follow them in numerical order. It's a guideline to thinking through what digital strategy is appropriate to your financial institution. So we really urge you to look at those and use them as a senior management team. And then in January, we will be offering 2 more webinars. The first one is on introduction to investment readiness, and this will be the audience for this are financial institutions that just really aren't familiar with large investors and what they expect and how the process works and all that sort of thing. The second webinar will also be on investment readiness, but focused on financial institutions who have experience with investors, are larger, more sophisticated, and are looking for additional investors and capital to meet the Bank of Ghana's increasing requirements. So we will be sending out notices about the dates before the holiday season and again immediately thereafter. So with that, Andrew, if you have anything else, I think we can close this session.
No, from my side, I'm done. Alex?
Okay, I'm here. Sorry. Thank you so much, Len, and then thank you so much, Andrew, for the session. Thank you for taking us through the process. We are grateful so much. Participants, we are so grateful for your time spent. We are looking forward to you in our next webinars. Like Len said, in January, we're going to have 2 of them. And then first of all, we'll have an introduction to investment readiness for those of us who want investment but have not gotten before. And then we'll look at those also who have gotten that experience already. Thank you so much. And I'll meet again. Notices will be sent, all the materials and some handouts will be sent to you in your emails. And then adverts of the next webinars will also be published with the association so that you can also join when the time comes. Thank you so much for joining. God bless us all. Thank you.